Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Imagine making money in the stock market without ever buying a single share. Sounds impossible? Welcome to the world of short selling, where investors bet against a stock and actually profit when its price falls. Today, we're breaking down exactly how this works, why it's so risky, and how ordinary traders have used it to make fortunes, or lose everything. Most investing follows one simple rule: buy low, sell high. You purchase a stock, wait for its price to rise, then sell for a profit. Short selling flips this idea completely upside down. Instead of betting a company will succeed, short sellers are betting it will struggle. Here's how it works, step by step. First, an investor borrows shares of a stock they believe will fall in value, usually through a broker. Second, they immediately sell those borrowed shares at the current market price. Third, they wait for the stock price to drop. Fourth, once the price falls, they buy back the same number of shares at the new, lower price. Finally, they return the borrowed shares to the lender and keep the difference as profit. This final step is often called covering the short. Let's put numbers to it. Say a stock is trading at $50. An investor borrows 100 shares and sells them immediately for a total of $5,000. Weeks later, the stock drops to $30. The investor buys back 100 shares for $3,000, returns them to the lender, and pockets a $2,000 profit. That's short selling in its purest form. But here's the catch. When you buy a stock the traditional way, your maximum loss is limited since the price can only fall to zero. Short selling works in reverse. There is no ceiling on how high a stock price can rise, which means the potential losses are theoretically unlimited. A stock could double, triple, or climb even higher, and the short seller would owe every bit of that difference. Short selling also requires a margin account, meaning investors need enough collateral to cover potential losses. Brokers charge borrowing fees for the shares, and if the stock price rises instead of falls, the investor may face a margin call, forcing them to add more funds or close the position at a loss before they're ready. This risk becomes extreme during something called a short squeeze. It happens when a heavily shorted stock unexpectedly surges in price. Short sellers rush to buy back shares to limit their losses, but that buying pressure pushes the price even higher, creating a snowball effect. In early 2021, this exact scenario played out with a popular retail stock, as coordinated buying from small investors triggered massive losses for short sellers, sending the stock price soaring within days and making headlines worldwide. Despite the risks, short selling plays an important role in financial markets. Hedge funds use it to hedge against losses in other investments, balancing out risk across their portfolio. Some investors use it to bet against companies they believe are overvalued or engaged in questionable practices. In the years leading up to the 2008 financial crisis, a small group of investors famously shorted the housing market, correctly predicting a collapse that most of the financial world failed to see coming. Traders often look at something called the short interest ratio to gauge how heavily a stock is being shorted. A high ratio can signal that many professionals expect a company to struggle, though it can also set the stage for a dramatic short squeeze if sentiment suddenly shifts. Some investors even track this number daily, treating it as an early warning sign of where the next big market move might come from. But short selling isn't without controversy. Critics argue it can amplify market crashes, spread panic, and even be used to pressure stock prices downward through coordinated negative campaigns. Because of this, some countries have imposed restrictions or outright bans on short selling during periods of extreme market volatility, especially during financial crises. So, is short selling something everyday investors should try? For most beginners, the answer is no. The strategy demands deep market knowledge, strict risk management, and the financial cushion to absorb potentially unlimited losses. It is a tool built for experienced traders, not a shortcut to quick riches. This video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If you found this breakdown helpful, hit subscribe for more clear, simple explanations of how the financial world really works.